Good afternoon, everybody. Welcome to TraderMerlin Show. It is your weekend edition. It's Friday, the 5th of May, and just for Tom Barr, we're going to do a 2-hour show today and talk nothing unless it's pertaining to Jerome Powell. I'm kidding. I wouldn't do a thing like that to you. It is back to whiskey day for me. Maybe this will help me knock out any remaining COVID cells out there. But cheers, everybody. Happy Friday. Going with Four Roses today. Cleaning off the bottom of the barrel, but it is a single barrel anyway, so that's pretty good. So here's the graphic I came up with for today. It is supposed to be a picture of Jerome Powell, and I said, just show me Jerome Powell, working at a circus, surrounded by a bunch of clowns, and this is the picture that was ultimately chosen for today's show. And I guess briefly in just discussing, you had a couple of banks that were rumored to be going under yesterday, and all of a sudden they had huge surges, some of the biggest gains they've had in quite some time. Check out WAL would be the first one. That's Western Alliance Bancorp. Yesterday just got absolutely slaughtered and then just bounced right back today. Unfortunately, my First Republic is dead in the water, so I'm stuck with my shares, and I'm not trading any of the bank stocks right now. But yeah, that was a nice bounce there for Western Alliance Bancorp. The other one being PACW. There you go. PacWest Bancorp also having a huge day up today. 81% jump today. Would have been nice to have bought the calls or sold some puts on that bad boy, but not touching it. Nope. Daryl, single barrel today. Single barrel of the Four Roses. Good stuff. Nice. It's been a good Friday. It's been a good week for me. Other than the exercise of FRC shares, which hurt pretty bad, but it is what it is. We'll make up for it. Had some nice trades this week anyway. So, let me talk about some of the pieces we discussed in the little preamble to today's show, because really it was all about Jerome Powell's comments yesterday, and I think what you're starting to see is a little bit of a shift in the sentiment from holding at the June 14th meeting to possibly raising. And the reason that I think the attitude of raising may come into play a little bit more is Jerome Powell's not necessarily concerned about the equity markets. I would say that in jest. Yeah, I'm always liking the puts I sold. I collected premium. I just don't like holding them, being exercised. If you look at what Jerome Powell's comments did, they calmed the markets a little bit and made them feel warm and fuzzy that, they're going to stop raising rates, which is great. Having raised 500 basis points or 5% over the last year is pretty dramatic. But is it enough? So if Jerome Powell's true interest is full employment and stable prices, we have two conditions that really measure that. And stable prices is your inflation gauge. Next week we have CPI coming out on Wednesday, PPI coming out on Thursday, so that's going to be a great couple of days of volatility there. But the other side of it is unemployment. And if you look at what he was citing at the press conference, he just kept going on and on and on about how employment looks good. And if we look at it, let me bring up the Forex Factory numbers here so I can show you today's numbers. Here is the unemployment data that came out today. It was 3.5%. All expectations were that it was going to go higher, and kind of felt like that would be the case. Unfortunately, not unfortunately, I guess great for the economy, we came in at 3.4%. So if I'm looking at those two variables, which is their dual mandate, stable prices and full employment, he's not worried at all about the employment numbers right now. And we could scroll back here a little bit and look at non-farm employment change. So non-farm employment change surged much more than expected. And earlier this week, we had, where's the other numbers that came out? Net farm productivity, unemployment claims. So unemployment claims were slightly higher than the previous, than the expectations, which were 239,000, came out at 242. So no big deal there. But our other piece of economic data came out on Wednesday, which is the ADP non-farm employment change, and that was double expectations. So all in all, things are looking very good on the jobs front. So the Fed can now be more aggressive. And I actually was looking at it today, but let me bring it up for you guys so you can see it. We had a 99.9% probability as of yesterday that there's going to be a 25 basis point increase at the June 14th meeting. And today it started to creep up just a little bit. It only, tipped from 0.1% to 3.9%. They would get a 25 basis point increase. Now, what I will tell you is next week, if those CPI and PPI numbers come out negative, meaning we're seeing inflation, subside, then you may actually see this drop back down to the 50 basis points. Or sorry, drop back down to no change. If we do see that inflation number surge or go higher, which all expectations right now are that it's going to go higher, the current expectation for CPI, it was 0.1. I believe they're expecting CPI to be 0.4. So a jump up in CPI, and also for producer price index, which was negative 0.5, they're expecting it to be positive 3. So all of a sudden, estimates are saying that our inflation is getting higher over the past month. Now, that doesn't mean that those numbers have to come out that way, but that's just what the market is pricing in or expecting. So if we do get higher numbers for CPI and PPI, then this table right here, in my opinion, is going to start to shift, and you'll see more people thinking about 25 basis point increase. This could be 20 or 30% by the end of next week if CPI and PPI come in much higher than expected. But personally, I do think that Jerome Powell will hold. I think that he realizes that the pressure that the Fed has been putting on these banks by raising the short-term interest rates, knowing that most of these banks are doing a typical borrow short, lend long-term, the higher they raise those short-term rates, the more it's going to hurt these financial institutions, and we're seeing, quite a bit of pain in that area. So we'll have to wait and see how it all transpires, but next week is going to be a fun one because of your PPI and your CPI number. Today's unemployment data, I thought actually was really good, smoking hot unemployment numbers there, coming out at 3.4%. Otherwise, I did not make any bank trades this week. I just shied away from it. I did have a question that was sent in to me about Charles Schwab again. So I still long-term am bullish on Schwab. They had a very nice day today, up 3.95%, but the chart does not look very good. You're seeing it drift lower and lower. You had a hammer formation yesterday, which wasn't too important because I wouldn't have been able to trade it based off of my rules, but you had a nice hammer formation, then ripped up today as almost all of the banking sector did. For those of you who watch XLF, which is the financial ETF, all the components that you see on the right-hand side of my screen, those are all the XLF components. And you see some of those, like Zion Bank shares up 19%, CMA up 16%. There were only a couple that were down, and that was, this is Helium. Let's get rid of that one. There was actually one that was down. That was CBOE, which really wouldn't be a bank, right? That's CBOE Global Market, so I wouldn't really call that a bank at all. But so great day for all the bank stocks. But, the question remains, are we out of the woods yet? Will we see some more pain going forward? You look at a lot of these that bounced today. Let's go to the top here and just look at Zion. This is, if for anybody who's taken technical analysis class, this just looks like a simple dead cat bounce, a retracement back into a supply, and the trend has been down. So, I don't think we're out of the woods yet. I still think there's more shoes to drop with regards to this banking sector. And there's a lot of analysts that are starting to lean that way and think that there's more pain ahead for banking. So just because we have this great pop today, don't think that we're out of it yet. Tom says unemployment went down while tech was laying off tens of thousands of job market is stronger than forecasters think. I think the housing market or the job market is incredibly strong. It's almost, scratching your head kind of strong. Like how is it that strong? We can look at, let me bring up the unemployment rate here and we'll look historically just to put it into perspective. 1 second here as I do some live data collection. Here we go. So here is, unfortunately, this only takes me back to 2006, somewhere in 2006. Oh, maybe I can go further. We'll go way back. So this gives me all the way back to 2002. Just look where we are from a height level, right? Here is 3.4%. We tiptoed down to around that in 2020. But if I scroll even further back here and go to 3.4%, we haven't been this low in 23 years. We could go back much, much further than this if I had access to the data. So, I'm really kind of shocked that we're in such a healthy jobs environment. No argument. I guess or no complaints. That's actually a good thing for the economy. It's just one less variable that the Fed needs to worry about. Although, you just kind of feel like if it's been stuck this low this long, that there's going to be something to shake that up, and we'll see a surge here. But so far, we haven't had it at all. Short the regional bank ETF. I'm not going to mess with it anymore. After the FRC thing, I was doing great with FRC, and then that last little bit caught me, and just because I've kind of a rule, Big Ab, which is if something burns you and you take a significant loss on something, don't go back into it right away. Let it cool off, because even though you may not agree with it or believe it, I firmly believe that there's a subconscious part of your mind that has a revenge trade attitude and is more vindictive towards that trade setup. So I won't be touching any banking stocks. The only thing I might do is I might look if bottom fish for some of the bigger names. I'm not going for any regionals. I'm not going to mess with PACW or Cal or anything like that. Just leave them all alone. But, does it mean I might look at some Charles Schwab, or, as I wrote in that article, Bank of America or JP Morgan? Sure. Charles Schwab is probably the one that I'll be looking at over the next couple weeks as a potential long-term hold there. Last month's job numbers revised down a bit. Yeah, and again, when you look at the data that comes from the Bureau of Labor Statistics, I don't trust it. As I've mentioned many times, I interviewed a guy who used to work for the Bureau of Labor Statistics, and he said the data was manipulated. He says they change the parameters. I don't trust the data that comes out of there. So it's nice to see 3.4%, but as John O'Donnell would say, you want to use the U6 rate. U6 rate, which is, let me see if I can bring this up for you guys. There's the U6 and then there's the U3, which is U3 is what we are quoted, and here is the rate. So right now you can see it says 3.4% over here. The U6, which is a much broader representation of those seeking work, or as it says, marginally attached to the labor force, that shows unemployment around 6.6%, which to me would seem a more realistic number, but I don't know. All in all, I'm just using it as a broad measure of how I should start to position myself, or at least how I should anticipate what the Fed's going to do. Because at this point, if the Fed keeps raising, economy is going to grind to a halt at some point. If the Fed pauses, I think you'll see a nice surge, because of the market's going to price that in and go, oh, relief, we're no longer raising, that's good. So I'm just looking at unemployment as, if I'm Jerome Powell and I see that the unemployment numbers are staying incredibly low, I can remove that from my concern, and now all I have to think about is the inflation number, per my dual mandate that was given to the the FOMC. So that's the Federal Reserve's dual mandate. Therefore, he can be more aggressive if he wants to with unemployment, or with regards to rates, because of the inflation data. Questlock says, I don't know if the jobs report is a good indicator. We had a lot of quality workers that didn't come back to the workforce. Correct. And it's not about the quality of workers. And we could make the argument that you have someone who had a $150,000 job, right, before COVID. Things are going great. Now all of a sudden the layoffs, work from home. Maybe they're scrambling to find a job that's paying them $60,000. So yeah, they're back to work, but the income for that individual has declined. And I'm sure there's metrics out there that measure that, but I don't have access to that one at this moment in time. So that's our main couple pieces to focus on for the next week. It's just going to be that CPI and PPI numbers coming out Wednesday and Thursday. You also have a rate announcement next week for the UK, but that shouldn't be too big of a deal. They're expected to jump 25 basis points. The one surprise that happened this week with regards to rates, you guys may have seen this one, the ECB. And we go back here. Where was it? Scroll back there. There's your ECB press conference. Their main refinance rate, okay, so that it wasn't really a surprise. They expected to jump 25 basis points, and they did jump 25 basis points. But remember, ECB started raising rates way later than everybody else. Every other country has been raising rates for quite some time, other than Japan, of course. You can see they started raising in July of 2022. And if you look at what the U.S. has done, let me show you theirs. Let's go Wednesday. We've been raising since, come on, Merlin. Going back to March. So April, May, June, July, we got them beat by a few months before we started rallying up. All right, what did Tom got for us? Fun fact, the Powell movement was negated today. SPX came back up 90 points from yesterday's low and got back to pre-FOMC. So let's run through our top 7 here just so we can kind of get through that part of the show today. There we go. So I'm going to start at the bottom, and we'll get to the S&P here in just a second. So you have that a sell-off on gold today. Obviously, equity markets have a really strong rally. That tends to be a risk-on event, and that moves people out of gold, which is fine. I actually hope gold and silver sell off more so I can sell some more puts at lower prices. I have a bunch of puts right now on silver at the 2150. I have to look at it real quick. Got too many things going on. Too many I think I actually have the 22s, as well highlighted here in blue, as that last rally-based rally. So the 22s, I've got a bunch. I think I have 40 SLV puts at 22, which got me a little bit over 1%, but that was done earlier this week. You can see that nice rally certainly helped my put options. But I wish this would have sold off more. We had a 1.55% slide for silver today. I'd love to see it drop down so I can sell some more puts and get better rate of return and ultimately own silver. I'm fine with that. But gold was the topic here, down 1.5%. I still have that line at 1989. That's kind of, call it 1990. That's the line in the sand, if you will, the blue line there at the bottom. Let me get rid of some of these other lines because it's going to get confusing for viewers. That blue line near the bottom is kind of the line in the sand. If we end up breaking that, then all right, my bullishness will dissipate on gold. But at this point, still feeling comfortable. We haven't had the follow through from this breakout that we had a while back, but I'm still long-term bullish on gold. That's your number 7. Number 6 is the Dow, which erased half of the last 4-day slide in one day, 1.64% gain. But technically, it's not telling me much, right? You've really just had sideways action since November. It felt like we were starting to make some lower lows and lower highs, and then all of a sudden we rallied back up, and now it just feels like it's just traversing sideways. So we may get a yellow box on this one in the near future, but nothing technically that's really tradable here on the Dow. The S&P, as Tom says, this came back up 90 points from yesterday's low to get back to pre-FOMC. Yeah, we were above where the FOMC came out. So this Wednesday right here, you can see Thursday was down in reaction. Now we all of a sudden ripped back up. And a lot of that, I believe, is due to the unemployment numbers that came out today. Also, optimism over the regional banks, which, this is going to keep changing, guys. Right now, the last day, it's optimism over regional banks, that the issues aren't that bad, that it's just false rumors being spread by short sellers, yada, yada, yada. Watch next week, it'll be another catastrophe and, something legitimately failed and FCIC bailed them out. And then it'll be, no, we're good, it's fine. So you're going to get this volatility with these banking stocks. It's just the nature of the beast right now, and who knows which way that damn thing's going to end up going. So that's your S&P. Again, technically, I don't see anything here that's noteworthy, right? Other than we've been on a nice uptrend since October of last year, I don't see anything in the short term here that says go long or go short. It just looks like a tremendous amount of volatility. So day traders dream, swing traders, not the greatest thing to be seeing. All right, almost to the podium. Here is the NASDAQ 100, which is up 2.1%. This one is a little more noteworthy than the S&P, primarily because here we are back up at those highs. We've had this line drawn. Actually, I should be up here around those highs. We came right into the high that we saw back on May 1st. The closing price from May 1st, and this is looking more and more bullish every day. So if we get a nice pop here, your next stop is going to be that high that I've got drawn out with a yellow box, which I will extend on out. Let me get that box extended. There we go. So we'll stretch that one out. That box is between 13,630 and 13,760 for the NASDAQ 100 futures, and that will most likely hit. I mean, this looks really good. We have had very good earnings. I mean, if I run back through my mind of all the companies that came out, at least the ones that I remember as having beat earnings, there are so many more that beat earnings versus missed earnings. The only one off the top of my head that was a big miss was Mosaic. Other than that, we had CVS and Vertex Pharmaceuticals, Arista Networks. You had Ford, AMD, Pfizer, Chesapeake Energy, Starbucks, BP. You had Square. You had Shopify. You had, what are some of the other ones? Apple, Kraft Heinz, Etsy. All these companies beat earnings this week, which is a very good sign. Of course, I'm a believer that they lower that bar so low that it's easy for them to beat the earnings estimates. Either way, it's relatively good for the markets to have these companies beating earnings. The only negative news here is all the big stuff that drives the NASDAQ. Talking Google, talking Microsoft, talking Apple, talking Amazon, have all reported, right? That's all been reported out, and most of it has been pretty good. So all in all, looks good for me for the NASDAQ. On the one index that I'm pretty bullish on, that's the NASDAQ. I had sold puts on the triple Qs as well as XLK. And XLK, by the way, for those who may not know, is just a simple, it's more reduced. It's got fewer components, but it's predominantly focused on tech. There's your XLK, which is even better than the NASDAQ because it's actually sitting right up at overhead supply. Once that breaks, we've got a couple of unfilled gaps on XLK. So I'm feeling bullish on XLK, but I sold puts on it instead of buying directionally. And lastly, or last three, got to get to the podium. Russell 2000 having a monstrous day today, 2.4%. I'm actually cheering for the Russell to decline just because I like it when I say things in articles that I write, which are now permanent record. I always like when it follows through. But Russell had a nice bounce today, really erasing almost 3 days worth of losses. You had it to 1765 was your ending price for the Russell, up 41 points, but still technically doesn't look great, right? It just looks choppy. It looks weak. It's not been able to make new highs, even though today was a juggernaut monster of a day. Didn't look great at the end of the day from a technical perspective. So I'm still bearish on the Russell. Bitcoin, finally a little pop there. We've had this consolidation. We have this little symmetrical triangle right here for anybody who's a Bitcoin aficionado or is addicted to Bitcoin like I am and the future of digital assets. You have this symmetrical triangle or pennant formation that we're still kind of in. You could argue that we just barely broke above it today, but I'm not going that geeky on the technicals. I'm bullish on Bitcoin for the long haul. I'm going to actually be producing a video this weekend for barchart.com, which will map out the path of the future of Bitcoin, at least for the next, let's see, what year is it? We're in 2023. This will be for the next almost 3 years. So I've got a 3-year roadmap kind of mapping out for this Bitcoin that I'll produce this video. Hopefully get it done this weekend. I really owe Barchart. I have to write another article for them as well. So I got to write an article and I have to do a video for barchart.com, which I should have done here hopefully this weekend. But Bitcoin looking pretty good as well. Higher highs, higher lows. I was getting a little nervous when we came down to 26,666, right? Kind of, you got the devil in there, 666. I was worried we might break down below that, but we didn't. Good news is we're holding. Ideally, we get above 30,950. My guess is that will probably happen this weekend. I know it sounds crazy, but going into the weekend with this optimism for equities, risk on type of thing, I could see Bitcoin actually doing really well. For those who are Bitcoin haters, you have to understand that Bitcoin represents the antithesis, the opposite of what the banking system is going through. Printing of money, reckless investments, and manipulation. Bitcoin can't be manipulated. Bitcoin can't print anymore. There's no printing of dollars to bail out Bitcoin. It's just Bitcoin, and there's a specific amount. So again, it was designed to let you be your own bank and manage your own money. And I think that the more we see this crisis, this shit show in the banking world, a lot of people are opening up to the idea of, maybe I should just be my own bank. Maybe I should, if I'm a financial firm that is raising capital and I raise $100 million and I put it into Silvergate or Silicon Valley Bank, right? I got $100 million loan. I got VCs just give me huge money for my business. I put it in there. My money's only guaranteed up to $250,000. If I put it into Bitcoin, as long as I keep track of my private keys, my money's guaranteed forever. I'm not going to lose my Bitcoin. Now, I will suffer from fluctuations in price, but if more people start to use it as a banking system and a store of value, then the price of Bitcoin will go up. Also knowing that there's destruction, meaning people lose their private keys. And at this point, there's roughly 6 million Bitcoin that have been lost. So supply is declining, demand is increasing. That's a recipe for a much higher price of Bitcoin in the future. But slowly getting there is my idea. Hey, Chris, good to see you. Have a good Friday. Happy weekend. Hey, Doc S, thank you very much. I appreciate that. It's always nice to see the votes of support. Russell's perfect right now. Leave it alone, Merlin. Okay, yeah, we'll put a box around it. I'm okay with that. Just keep chopping back and forth and let you sell that premium, Tom. I'm all in for that. That sounds good to me. Here's one that I apologize I didn't bring this one up yesterday. This is the biggest gainer on the day. I have been selling a good amount of puts. I'm in 30 now of XLE at varying strike prices, 77, 76. And I think 77, 76. I think I have some 78s as well, but been selling a bunch of puts on that because the premium's been really good. Yesterday, we had a monstrous hammer formation. Now, it's not perfect. I know a lot of you, let me zoom in here real quick. When you look at this formation, the last candle on your screen, that's a hammer formation. And I know some of you might say that that topping tail is a little bit too long. The bottom line is, at one point on Thursday, crude oil was tanking. I mean, it was down huge. It was down on the day at its lowest point. Let me bring that up. 7% slide. So great day to be selling puts when there's blood in the streets and people are looking for protection. Of course, if we zoom out here, you can see that it came all the way down to the low points from March 20th. So, kind of a double bottom formation here. So I was selling some puts into that. We had a hammer formation, which for anybody who follows my rules on hammers, all you really were waiting for was a break above yesterday's high, which is right there, and would have been a nice play today. And I have a feeling we'll get some follow through on this one, possibly up into about that 76 level, which you can see was the origin of this last move down here on May 1st. So there we go. And that's your top seven markets. So I saw a question came in earlier. Let me get to the question here. Of course, you guys always send in good stuff. Let's see, where was that from? That was from Tomasina. Thank you for the question, Tomasina. She says, any thoughts about the new ZIVB ETF? Honestly, no. It's a short VIX ETF. So I don't trade the VIX anymore. In my personal opinion, this is just me being a biased, bitter cynic of the markets, I don't believe it really works anymore. So again, it used to be when the VIX is high, time to buy. VIX is low, time to go. That was the mantra that industry has used since VIX was created. Need some 4 roses for the next topic. But when we broke above it back in the financial crisis in 2008, the VIX got up to like 99 or 100. I mean, it was soaring, and anybody who was using that mantra got absolutely smoked and destroyed. So I don't really use the VIX. If you want to see if people are panicking, do you need to look at the VIX? Let me ask you guys, if you want to know if people are panicking in the market, what's a simple, easy thing to look at? What should you just look at if you want to know if people are panicking? It's real simple. Remember, VIX is they call it the fear index, the fear gauge, and really it's designed to show you puts versus calls. So if a ton of people are buying puts, that means that people are freaking out looking for protection. The house is on fire, they're trying to buy insurance as the flames are going on. That's typically what VIX measures. But I don't really need that. All I really need to do is look at the market. I can bring up the S&P and I can see if people are panicking, right? I think bonds, you can look at bond markets, but I just think you look at the price chart of whatever it is that you want to see panic on. And then as Questlock says, volume as well. Volume really gives you you can see the screaming going on with volume. So let's, for example, look at crude oil, right? I don't think anybody here would disagree, but did you think that there was panic going on in crude oil the last week? I mean, it fell from $76 all the way down to $63. There was absolute chaos going on in crude oil yesterday. So as Questlock says, let's add on volume here. You don't actually, this is not the best representation, because what you'd love to see on this last candle, on this candle here, is the highest spike of volume, right? That when you get capitulation or climactic volume on a big sell-off or a big spike, that to me is the best thing to look for. Well, we didn't get climactic volume on crude oil, so that reduces a little bit of the emotion, but the size and range of that candle tells me that there was chaos and panic out there, that people were freaking out, especially the size of these red candles. There was absolute pain going on. I don't need VIX. So I could go out here to the S&P. None of these days really scream panic. They're all just seem like normal bullish. There's today was a big bullish day, but honestly, we had a day that was just as big last week, right? Last Thursday, we had another huge, big green candle. So I don't know. I know I'm beating around the bush, Tomasina, and answering your question. So let's go. ZFB? It's not ZIFB. It was ZIVB. ZIVB. So here's your brand new negative short-term VIX. So it's using different futures product, different VIX futures products, and doing the inverse of it. Personally, I would just stay away from it. I don't really see a need to be using the VIX or VIXX, and it's just me. You guys are welcome to trade that stuff. I just, I can't even. I thought it was VIXX. I didn't even look at these things anymore. All I look at is the VIX. So Maybe I'm being one-dimensional and being jaded, but Thomasina, I don't really have any feedback on it. I don't use them. You know, I used to, when I was back in the trading floor in the late 90s, I used to look at VIX and use this when VIX is high, time to go, or time to buy. When VIX is low, time to go. That was my mantra, and that was about 20 and 40 were the numbers there. You guys can see I've got 20 and 40 mapped out. Let's get rid of that. Let's get rid of that. Those two horizontal red lines are typically measuring the mantra. VIX below 20, that means that it's time to get out of your position. If you're long, it means to sell your positions because people are becoming complacent. It's gone up too much. There's no fear whatsoever. Fear's coming. If VIX is over 40, VIX is high, time to buy. That means that people have been panicking. And if you look at this, we really haven't had any panic since the pandemic lows, right? If you're using 40 as your crossbar here for the panic level. But we've had a lot more complacency. A lot more people just kind of sitting there enjoying the ride. I don't use it, Tomasino. It's over. I like to look at it, but I don't really do anything with it. All right, let's see. What other questions I have? I didn't really spend time looking at questions yesterday. Let me see if I had any that I did not get to, which I do not. Okay. So a couple other things I want to look at here before we wrap up. We'll keep it a short day today so I can go out. I have to go write this article and record a video. One other piece here was that 10-year. So here's your 10-year yield, which is up 1.74%. Still kicking at 3.44% overall, which is fine. I'm going to keep this line on here at 3.25%. It's actually 3.26, but I will pop this and make it a 3.25. Right, so 3.25% is kind of that line where you've seen this bounce off of. It's kind of maintaining those lows. Anything below that, then all of a sudden, you start to feel more bearish on this bad boy. But I think 3.25 is kind of your backstop here for the 10-year. Yield curve wise, we talked about this with Bill Addis the other day. We still are on the 10 and the 1 year very inverted, right? You're over 1.3%. That's just inconceivable that you could get 1.3% more for holding a 1-year bond versus buying a 10-year. Just crazy stuff out there with regards to bonds. But here is the industry viewpoint, which is the 10 and the 2. You had that drop fairly significantly today. It was a 15% slide in the differential between the two, but still almost a 0.5% better to hold a 2-year versus holding a 10-year. And that was it. You saw commodities do rather well today. Oh, I'm going to talk about the Dixie. Here's your dollar index, which has been drifting lower. I drew this head and shoulders pattern a couple weeks ago. I'm going to leave it here because this could come to fruition. The reason I think it's looking more likely is what's happened over the past 30 days with the dollar index. It has not been able to rally at all, right? It's just kind of been flatlining right against 101, which is this blue line here. And I think once you get below that, there could be a bit of panic, and all of a sudden that dollar really start to tank, which is, I guess due course if they're going to be printing more and more money. Print it. Anyway, let's see. Schwab had panic volume a few months ago. Schwab had basically everything but everything in the banking sector. Let's go look at climactic volume, and of course, it's easy to go back after the fact. This was the this is the Silvergate day. You can see monstrous volume, and what's interesting about that one. This was actually the day that I think my article came out. I believe I was talking about buying Schwab, and it actually had a nice pop the next couple days, and since then really hasn't done much. It's been drifting lower. But yeah, you had that on JP Morgan as well. All right, so you can see some real nice pops here with JP Morgan and volume spikes. But yeah, generally that's going to be my fear gauge in that panic moment. I don't need the VIX to tell me that. If I want to know what fear is going on, I'll simply look at the S&P, check the move, and add on volume there. But yeah, no real need for me to freak out with that one. No problem, Thomasina. Yeah, no, it's just I had a talk a couple nights ago with a friend of mine. We were talking about markets and trading, and he's relatively new to trading. And he's trying to study all of these things. And one of the challenges I think that everybody faces, some of you may be going through that one right now, is you got one person saying, hey, I use this and I use this and I use this. And another person going, oh yeah, don't use that, use this and this and this. And then everybody's telling you got to use this, or look at these markets, and oh, you should be trading the VIX. Then look how much volatility there is in the VIX. It's huge money, and oh well, you should be doing options on VIX. And I don't know. I think that part of success in this is dumbing things down and keeping it extremely simple and not making it more work than it has to be. I think that the more we look and try to make excuses for bad trades, the more likely we'll find something that was, bad on that specific trade setup. So if you keep your rules very simple, it's much easier to target what you did right, what you did wrong. VIX is just a chaotic instrument, in my opinion. I sold my puts then. All right. All right, that's it for me. I guess I should tell you what's happening on Monday. I didn't look at there really is not much happening next week except for the Wednesday, Thursday piece. But here's the calendar for Monday's session. You can see for the U.S., there's not a lot going on. You've got 3 pieces. You have final wholesale inventories. You have FOMC stability report. But let's see how that's going to turn out. There you go. That's right. Lisa's program with simple options, getting that clubhouse session. Exactly. Keep things as simple as possible. Otherwise, not a lot of big announcements happening. You got bank holidays for UK and Europe, so not a lot of really important economic announcements. And then earnings-wise, there's really nothing big happening the first part of next week. I can bring that up for you if you guys would like. Let me bring up this one. We'll go over here to the earnings calendar, and I'll show you what's cooking for Monday. Here we go. 271 companies reporting on Monday. You have PayPal, Western Digital, Skyworks Solutions are the big one. And CRISPR Therapeutics. People asking me a lot about CRISPR and that whole thing, which maybe we'll do a show on that eventually at some point. Exactly, Dave. Paralysis through analysis. One of the funny graphics. So when I first started with Online Trading Academy back in 1998, there was all this content. And they had like 5 or 6 different instructors that had built stuff. And, when someone was asked to teach a class, they would just here's my content. So what I did early on is I took all of this content from multiple instructors and I sat down, put them on multiple screens, said, let's structure this to a logical educational flow, incorporating all these different pieces. So I brought them in and I made this course cohesive, clear, and it had a goal and objective and a reason to get there. But one of the graphics was from one of the traders on the floor, and he got so frustrated because he had, I swear, on one chart, stochastics, Bollinger Bands, MACD, ADX, DMI lines, moving averages. He had volume, and there were a couple other things and some trend lines on there. It's like, dude, parabolic SAR. It's like, I asked him, I said, what's price doing? And it took him a second to actually say what price was doing because there were so many indicators on there. But yeah, paralysis through analysis. Mike McMahon, who I want to get on the program here again soon, he used to always tell me, if you torture a chart long enough, it'll tell you whatever you want to hear. And I love that one. I absolutely love that one because all of you have experienced that where, your mind says you're bullish on something and you look at that chart and keep adding indicators until you find something that validates your decision. You go, see, it's bullish. Dwight, new trader, could you please do a couple shows that goes over your rules for trading and how you determine the rules for you? Yeah, we can do that. I've done them in the past. You might want to look at the archives. I think I have this 10 laws of trading, which has been hanging on my wall and sitting on my desk in every room for 15 years now. And I modify it slightly, but now it's kind of cooked. Yeah, maybe we can run through that and do a little bit on establishing your rules and kind of what goes into developing those rules. Sure, I can do that one. Keep your eyes open for that one, Dwight. I can't say I'm going to do it next week. Every time I get a topic like that, I got to build out some content. Right now, I'm extremely busy doing a million other things. So I will try to get to that one. So keep listening, keep bugging me for it as well. If you don't see it in the next week or two, ask me, and I'll just keep pushing. You can always email me at TraderMerlin and bug me there, and I take it as a positive thing. All right, that's going to do it for me, guys. I'm going to go take a break, walk the dogs, and it was raining out here this morning, write an article, record a video on Bitcoin, and then I'm hopefully going to enjoy and have a fantastic weekend. So I hope you all had a great trading week. Don't let the bank stock scare you too much. And cheers. I will see you all on Monday. I'm going to try to get a guest or two for next week. This week was fairly jam-packed with guests, which was awesome. But next week will be a bit lighter, and I'll have a chance to catch up with some questions. So if you have them, email me at TraderMerlin@gmail.com if you have questions, or put them down below any of the YouTube videos. Cheers, everybody. Have a fantastic weekend. I'll see you on Monday. Take care.